The markets have taken an absolute hammering overnight and have woken up this morning with a nasty hangover. US tech taking an absolute dump, down 5% overnight. And the key here is that it's broken out of an upwards channel that it's been trading in since March, not looking good in the short term. Who's to say what happens at market open on Monday, but the chart is looking nasty. Now this has had a flow-on effect to the precious metals. Gold down over 3%, silver down over 8%, and platinum down over 6% for the day. And in this video, we're going to talk about what happened, why it happened, and what the ramifications are moving forward for the markets. What a time to be alive. Now, why did all of this happen? Well, we saw some jobs data come out of the US, specifically the non-farm payroll data, which is the most important data released for the month. The data itself was much better than expected, ironically. The US economy added 172,000 jobs in May, which was more than double the estimate of 85,000 jobs. Now, why would good news mean that the stock market drops? Well, the answer comes down to interest rate expectations. Now, why has this increase meant that interest rate expectations have gone up? Well, the logic is that now that the economy is running hotter, we're going to see more inflation, and that means that they cannot drop interest rates. So in simple terms, more jobs means more spending, means higher inflation. And the way that the US Federal Reserve controls inflation is through interest rates. So how do rising interest rates affect share prices? Well, twofold. First of all, the companies themselves, these interest rates represent the cost of their debt. So a rising interest rate means rising debt payments for them, which is bad for profits. Now, secondly, is the investor and trader side of things, where hedge funds, traders, people that have loaded up on shares with leverage, sometimes from a bank, through a margin loan, or just an outright bank loan or credit card, or some combination thereof. They've gone out, they've bought shares, and now they've got a debt to repay. And the rising cost of that debt means that some of them will choose to take some profits off the table from their shares and pay off some debt. Now, the Federal Reserve has to take this jobs data essentially on face value and incorporate it into its interest rate policy. But for us, we get to take a deeper dive into the data and see how murky reality really is. Now, the first thing I'd like to highlight is that Donald Trump literally fired the head of the agency that calculates US jobs data in August of last year. Now, she was fired just hours after the July of 2025 jobs report was released, which had a jobs data number that was under market expectations and therefore not to Donald Trump's liking.
Bing, bing, bong, bong, bing, bing, bing.
Trump publicly accused her of faking the employment figures in order to purposefully make his administration look bad. Now, this is completely on brand for Trump, going after the heads of agencies that are bipartisan because they do things he doesn't like. Cue Jerome Powell. Now, if you didn't know, earlier this year, Donald Trump heavily pressured Jerome Powell to drop interest rates. Jerome did not. And Trump took this as far as even threatening Jerome with a criminal indictment, all because he wouldn't drop interest rates.
Federal Reserve Chair Jerome Powell says the Trump administration is threatening to indict him.
You said that you would demand that the interest rates come down.
Well, I would.
Do you expect the Fed to listen to you?
Yeah.
On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
Now, other than the issues around the validity of the data, there are also issues within it. What the report showed was that leisure and hospitality had an increase in over 70,000 jobs alone. Now, these are businesses that are around food services, and drinking, which are businesses that naturally see a spike during summer months. Now, these jobs are typically not very well paid, with no career stability or progression, but they do keep people off the unemployment line. Speaking about the unemployment line, there is also a widening gap between what's called U3 and U6. Now, U3 refers to unemployment, those with no jobs, and U6 refers to people who are forced to work part-time or multiple jobs because they can't find a single job or career to work full-time. Now, what this data is showing is that whilst the unemployment rate is remaining steady, the underemployment rate is increasing. All of which can be seen as a weakening in the US jobs market, not the strengthening that you'd see on the face value of it. Now, it's also important to consider here that 55,000 of these jobs were in government, most of which in local government. Now, again, whilst all of these jobs do keep people off the unemployment line, they're all taxpayer funded. So again, not a big win for the US economy on that one. Now, I mentioned in the introduction of this video that the US stock market, specifically US tech stocks, the NASDAQ, have broken down out of an upwards channel that they've been trading in since March of this year. Now, it's also important to consider that this is an almost parabolic upwards channel. It has been an insane few months for the US stock market, particularly tech stocks. Over the last few weeks and months, we've seen retail traders piling into tech stocks, particularly semiconductor stocks and AI stocks, with increasing leverage, chasing this parabolic move to the upside. This is bubble behavior, and historically never ends well. There are echoes of previous bubbles, just like the dot-com bubble, the 2008 crash. The signs are there for those who wish to read them. Now, I started Liberty Bullion in the first place because I truly believe that gold, silver, and platinum will be the best places to be financially for the next 5 to 10 years. And the reason I believe that is because we're in a high inflation and rising interest rate environment. And the closest similarity for the time that we're in now, I believe, is the 1970s. Now, what did interest rates, inflation, the stock market, and precious metals do during the 1970s? And is there a period in that time which is most reflective of where we are now? Let's have a look at the charts. So, with the chart in front of me, you can see the gold price as well as the US interest rates and the Dow Jones, which is a US stock market index. Now, let's remove the stock market index for a second and just look at gold and interest rates. So, we can see that both gold and interest rates both trended up for the decade. So you can see here that the 1970s started off with a moderately low interest rate. Now, things did heat up for a bit with interest rates increasing through to about 1974, but they figured that they'd defeated inflation and then dropped interest rates for a few years. So you can see here the gold price went from about $50 US to about $200 US, which is approximately like 4x return. Both gold and interest rates increased together from 1971 through to 1974. And then they dropped together through to August of 1976, and then they both rallied from there. Now, if we zoom in a little bit on this chart here, when we compare the gold price and interest rates together, you can see that there are definitely periods here where a rise in the interest rate immediately results in a short-term drop in the gold price. So there's similarities to today back in the 1970s. But what you can also see is that over the long term, rates and gold went up together, but also there are periods in the short term where they rallied together as well. So that short-term negative correlation that we're seeing at the moment between interest rates go up and gold comes down, whilst that relationship can be true and has been true in the short term, it is not going to hold over the long term. And that is why our focus here at Liberty Bullion is on long-term investing and not on short-term trading. We are not trying to make a quick buck day trading the precious metals here. This is a long-term investment where people can park and generate serious wealth. Now, what we can see when we add the Dow Jones back in is that first of all, the stock market essentially traded sideways for the decade, so it was definitely not the place to keep your wealth. But secondly, we can also see that that negative correlation between the interest rate going up, stocks going down, but also the other way around, when the interest rate goes down, stocks go up. That relationship worked back then just as well as it does today. So to finish this video off, let's give you a quick overview of all the places that you can choose to put your money. First off, leaving it at the bank. Cool, a guaranteed loss because the bank will pay you below the real rate of inflation. Lovely. Secondly, Australian real estate. Oh, well, with the budget changes we've just seen come through around negative gearing, have fun with that one. Plus, when you factor in stamp duty, fees, maintenance, all of that, and mortgage repayments in a high inflation and rising interest rate environment, the double whammy, no thanks. Third, crypto. Now, I did release a video about 6 months ago saying I'd sold all my crypto to buy silver instead. At that point in time, Bitcoin was at $95,000 US per coin and silver was around the $50 US per ounce mark. We've seen crypto come as low as $60,000 US per coin recently, while silver's still up about 30 to 35% from where I bought it. Now, where we're at in the crypto 4-year cycle of 3 years up, 1 year down, combined with crypto's strong correlation with US tech stocks, makes me very bearish crypto. Now, the stock market. Well, we've just seen the NASDAQ break through that key channel to the downside, with the rest of the US stock market following. Valuations are crazy high at bubble levels. And if we do see interest rates increase in a big way from here, that is definitely not bullish stocks. Now, quick mention here for government bonds, the absolute worst place to keep your money in a high inflation environment where the government is paying you below the real rate of interest. That is again a guaranteed loss. In the 1970s, they referred to bonds as certificates of confiscation because it was the government taking your wealth away. Lastly, precious metals. Well, with silver projected to hit 300 US an ounce within the next few years and then 500 from there, which is an 8x return from here, and platinum said to outperform it, the choice to me of where to park my wealth is obvious. So that's it from us today. We hope this video has helped you understand what's going on in the markets at such a tumultuous time. Now, if you'd like to come in and buy the dip with us here at Liberty Bullion, do please feel to reach out. You can either give us a call, send us an email, or come into the store, and we'd be more than happy to help you out with all your bullion needs. What a time to be alive.